This Mortgage Minute brought to you by MortgageBrokersOttawa.com.
Excellent. Frank Napolitano's here in a segment brought to you by him. MortgageBrokersOttawa.com. How are you?
Very well, thank you, and happy birthday, young
thanks
man.
a lot, buddy. I appreciate that. Listen, New Year's here. I was reading some stats there on a study on the housing market and so on and so forth. Prices are prices, and they're, 1 point something or other increase.
Yeah, not bad.
Not bad, eh?
Not bad at all.
Yeah.
Better in the first half, not as good in the second half of the year, but
the beauty of this is no matter what the price of housing has been in the last 12 months, the interest rates have been outstanding.
Outstanding. We started the year at 3.29 and we ended it at 2.99, so rates actually came down a little more than a quarter point over 2012. I wish I could say the same thing for 2013, but we don't forecast that.
It's tough to keep them this low, is it not?
It really is. It really is. The bond markets have already spiked over the last 2 weeks, so I anticipate that within the next week or 10 days, that 299 probably won't be around anymore.
So what are you talking?
309, 319. I mean, typically when rates go up, they go up in 10, 15, 20 basis points. So
gotcha.
But between now and towards the end of the year, I would not be surprised if at the end of the year, if we have this conversation a year from now, 5-year rates will be in the 3.5% to 4% range. I mean, there's no question. The anticipation is that rates are going to go up this year.
Yeah, just a little bit, but it makes a huge difference in a big mortgage, right?
It's incredible. Even last night, again, I sat down with a young couple last night, and just to show them, even though they're putting 5% down, how much principal, 58% of their payment went towards principal in the first 5 years, which is phenomenal. It's a phenomenal figure when you're starting off your mortgage, because historically, it used to be interest only the first 5 years.
Yeah, absolutely. So, like you would pay barely anything on your principal.
Barely anything on your principal in the first 5 years. It's just interesting to see. Now, even that very first payment has more going towards principal than interest.
So that points out in no uncertain terms that the time is now to kind of lock in if you want or get a real good rate.
I think one of the biggest problems that we have here is that consumers just take it for granted that their mortgages come up in May or June and don't do anything until April or May, when what you should be doing, especially in an environment where rates are expected to go up, you should be locking in a rate 4 months ahead of time.
You can do that?
You can do that. You should be doing that. If you call your bank and your bank won't lock in the rate, then don't give them the business.
Yeah.
If that's the case, go somewhere else. They're actually opening a door for you to go somewhere else, and if they're going to do that, give a mortgage broker a call. I mean, go to another bank, but don't settle for a rate that's too high on your mortgage, because it's the biggest debt you're carrying.
You talk about your debt to mortgage renewal, right?
Yeah. Incredible how many people I meet, and some people are so set that their mortgage is their mortgage and their other debt is their other debt, that they're paying so much more interest on their other debt, and they refuse to add it to their mortgage. And that's one of the biggest mistakes that I think a lot of consumers have, is that your debt is your debt. And if it's going to take you, have an example. There was a customer who came in and they have an 8% car loan and they figure it's going to be paid in 4 years. They don't want to add it to their mortgage. But what I showed them is that take the loan, add it to your mortgage amount now that your renewal is up, especially at renewal time.
Yeah. And
keep that car loan payment and add it to your mortgage payment and see what happens. And knock the mortgage down by 2 years. Even though most people in their mind say, but I've only got 4 years left on my car loan. Why would I add it to my mortgage? And now my mortgage has got 15 years left on it. But if you keep the payment the way it is after the car loan payment is done, that's where you really start to tackle your mortgage. And that's a mistake that a lot of people do.
What difference does half a percentage point make when it comes to your mortgage?
Well, it's $1,000 a year if it's a $200,000 mortgage. So
and it's at least that.
Yeah, at least that, right? So the compounding effect starts to happen.
But I think what happens is that as soon as the interest rates go up, your ability to pay at a quicker pace, right? Like doubling up any payments or going bi-weekly instead of once a month or whatever. That ability kind of disappears for a lot of people, right?
It sure does. Right now, when you're $299 for 5 years, I mean, there's many customers come in and say, that's it. That's what my payment is. They've got room for more.
Yeah.
When we're going to start to hit the 3.5% to 4% range, there's not going to be that. Boy, that might be a little tight.
Yeah.
And that's what we want to avoid. So, but if you got a mortgage coming up anytime between now and the next 4 months, boy, now's the time to start your shopping. Don't wait until April or May when rates are likely a quarter or half a point higher.
No, I don't know, but we got to run. But I don't know about everybody else. I'm no mortgage expert, so why not call one and ask the question if you don't know, right?
I totally agree.
Yeah.
It costs nothing.
Exactly. Frank Napolitano and his team will be happy to take care of you. MortgageBrokersOttawa.com.
Thank you.